Hey traders, this is Blake Morrow with Traders Summit, and with me today I have the one and only Marc Chandler from Bannockburn Forex. How are you, Marc? Good to see you.
Great. Thanks for this. I always enjoy seeing you.
Same here. It's great getting your perspective, and I want to also suggest to everybody that's listening in, one of the benefits of using the Traders Summit site, if you will, is like every morning. What I like to do is I like to sit down and Marc, I love to read your column in the morning. That's like the first thing I do because you tend to get up maybe a little bit earlier than myself. You've caught a few things, and getting your perspective on the market really sets my day up every day. So I need to encourage everybody to do it because you've been writing your column for how many years now?
Too long. But I kind of think what I do is like the tofu. Tofu is this partly digested soybean cheese. And I kind of think that part of my job, part of my team's job is to do that with the macro news so that I partly digest the news, tell you, here's the 3 or 4 things that important that happened. And what I try to do is put it within the context of the price action that keeps me grounded.
That makes a lot of sense. And I think that's going to make a lot of sense to the people at home. So, and that brings me up to like a couple of the our topics that we wanted to talk about today. How do you figure out what the Fed's going to do ahead of time? What do you do personally?
Besides pray, what I do is, I think the first thing to think about really is that the markets have an instrument that you can see what the collective wisdom of the markets got priced in. Because in some ways, right, it doesn't really matter what you or I might think. I mean, of course, it matters to us. But in the big scheme of things, what any individual person might think about what's going to happen doesn't really matter. What I want to know is what's in the market. And the best place to go is the Fed funds futures contracts. And this is what I really like about the Fed funds futures contract. When I was at a hedge fund, I was probably among the first people to trade it, and I had to really learn the nuts and bolts of it. And the 2 key things I'd say about it is, first, it is the biggest futures contract in the world, $5 million notional value. Put that in perspective for you, the Euro-dollar futures contract is much more actively traded, $1 million notional. Those bond and note futures, $100,000. So the Fed funds futures, $5 million. But what's interesting is that you or I could control that contract for a couple $1,000s. Now that's real leverage, but here's why. In the stock market, you put up margin money. How much? If you buy $100 worth of stock, the Federal Reserve sets the margin at 2 to 1. So you got to put up half the money of the value of the stock you're buying. It's like a down payment towards your purchase. Makes sense. You borrow the rest of the money from the broker.
Sure.
But in our markets, over-the-counter markets like currencies, but also in the futures market, the margin is a different story. The margin is really based on volatility, not how much you're buying. I'm buying that $5 million notional value of a Fed funds futures contract. But because it doesn't move that much, I cannot lose that much money in a day or two before my broker can sell the asset from me, right? If I don't make my margin call. And so what this means then is that your margin money in foreign exchange or in the Fed funds futures is really a down payment towards your loss. It's a different mindset thinking about it. So let's look at that Fed funds futures contract a bit closer. A lot of people get confused because they think it settles at the Fed funds target, which right now, as you know, is 0 to 25 basis points.
Right.
However, that's not how it works. What it settles at the end of the month is the average effective, which is a trade-weighted, sort of volume-weighted average of the month, which is publicly available. The Fed funds, sort of before the end of August, the Fed funds was trading, the effective average was about 10 basis points. So think about what that means. So we try to fast forward to when we think the market will begin pricing in a Fed rate hike. And so let's look at next September. And so next September, the meeting is on the 22nd. So we assume then that for the first 22 days of the month, the Fed funds will average what it's been averaging, say 10 basis points. And for the last 8 days of the month, the Fed hikes on the 22nd at the meeting, and the new target is 25 basis points higher, 35 basis points. So the first 22 days, Fed funds averaged 10 basis points. The last 8 days, it averages 35 basis points. You do the number, you multiply it out, and it gives you an average for the month of about 13 basis points. So then I look at the September contract, and it's trading at about 15 basis points. So that tells me the market's got it priced in.
Wow. Okay.
And you do the same thing. So I begin off with where the meeting's at, figure out what it should average before the meeting, what it averages after the meeting, assuming the move that I think, like a hike, and then seeing what the market's got priced in. So I say that as we begin thinking about the upcoming FOMC meeting, now that we're done with the ECB meeting, that's out of the way, the jobs there is out of the way, the next big event for these kinds of things is the FOMC meeting. And as we get ready for that, we have to think about what's the market pricing in, what kind of signals. And remember what happened at the June FOMC meeting. There were 7 out of the 18 Fed officials thought that a rate hike next year would be appropriate. The market has it priced in, more or less. And so for me, that's kind of an important thing of what the market is once again ahead of the Federal Reserve. I think the market has thought since March or April that there would be a tapering, a hint at Jackson Hole, followed up by a more concrete, formalized path, if you will, at the September meeting. And that's more or less what's happened, except for that little sort of twist, which is the July FOMC minutes contain that surprise that we were looking for at Jackson Hole, where the minutes said that a majority now favor tapering this year. So again, we begin off with the broad understanding how the contract works. It settles at the average effective for the month. That's publicly available information. And then you just play around with your scenarios. Assume something for the first part of the month. You assume the Fed raises rates. Then the average, you figure out what's in the average and compare that to what the market's got priced in now.
And so for right now, and just for everybody's knowledge, we're filming about 2 weeks out ahead of the FOMC, roughly. What would be considered a surprise in your point of view to the market? What doesn't the market have priced in at this point?
Well, I think that the market realizes that the Fed's not going to hike rates. Even if we get another print of CPI above 5%, there's not going to be a rate hike this year. Yeah. I think the market feels very confident of that. I think that the market's sort of wrestling with when does the tapering actually begin and at what pace. The signals I think that we're getting from the Federal Reserve is they want to do a more accelerated pace. But there seems to be a lot of people, several of the officials, seem to want a more accelerated pace. And so here's what I've tried to back into. I say, okay, the Fed's buying 120 billion a month of bonds, mortgage-backed and treasuries, and assume that they want to be done by the middle of next year. And that's an assumption on my part because I think that the Fed wants to hold open the possibility of a rate hike before the end of the year. After all, 7 of the Fed officials thought it would be appropriate. And I would suspect that when we get the dot plots for the September meeting, we'll see a few more join those ranks. Okay. When we get that, so I think the Fed's got to it's really about preserving maximum flexibility. And even though Powell says to guys like me, don't confuse tapering with a rate hike. We nevertheless will do that and say, as soon as you get done with the tapering, we're going to give you a period of time, a few months, and then we'll expect a rate hike. So I think what the market's not expecting is that the Fed would announce at the September meeting that it would begin tapering immediately or begin tapering in October, which is a little bit earlier. I think most market participants think it's going to happen in November or December. And, I'm just not sure it makes that much of a difference. I mean, of course, for us who follow each headline, it makes a difference. But for most of the market segments, corporations, the insurance companies, the banks, I'm just not sure that reducing bond buying 1 month early, a few weeks early, is really tantamount to a significant shock. Yeah. But we have to think about the pace again. So I thought that if we just assume that it reduces by the same amount every month and wants to finish up, it begins in December, finishes in June. So it's got 7 months to wrap up $120 billion, which turns out to be, I think there's something around $17 billion a month. That's sort of the base case neutral. We also know that probably, like last time, and like we see this talk about tapering, the Federal Reserve wants to avoid a hard stop. It would rather trickle into the finish line, so to speak.
Sure.
And to do that, it means it probably would have to slow down the buying towards the end, say second quarter of next year, which means they'll have to make up for that earlier on. So I could see how maybe if the average would be 17 billion a month, maybe they begin off with 25 or 30 billion and then slowly let it taper to, again, avoiding that hard sudden stop.
And we've all seen what a taper tantrum could do to the markets. I know one of the things I love about you, Mark, and you're one of the voices out in the market that not only look at like the macro point of view and really also you try to take into account everything coming in, but you also look at the technicals. And we've seen this grind higher in equity markets as of the last year and a half, but we're in a nice ascending wedge, and we're getting to that point where the market looks like it's got to make a decision one way or the other, like blast higher or have a little bit of a pullback. So
what's interesting is that there's this activity this week that is, to me, one of the big wake up calls.
Yeah.
It's not, of course, the different investment houses, they're going to revise earnings and their outlooks for the stock market. I get all that. That's just like, trying to catch these moves. But to me, I spent almost 15 years at Brown Brothers, which is a last of the partnership banks, like Merrill and Lehman. These used to be partnerships, Goldman Sachs, but they've like different sort of corporate organizations. But Brown Brothers is the last of the old partnership banks. And in the last 30 or 40 years, of which I had my 15 years or so, they became very large custodians. That is, as the asset market rally, the secular rally took off, Brown Brothers, these individual partners, right? They basically rode that wave by expanding into that custody business, and of course, ancillary business to the custody business, securities lending, currencies, servicing these clients. And this week, Brown Brothers announced it was selling its asset servicing business.
Whoa.
Including the foreign exchange, including the securities lending, and these other services that are provided to asset managers. They're selling it all to State Street for something on the magnitude of $3.5 billion. And what strikes me about it is that these are thoughtful, wealthy businessmen who seem to me to be taking their chips off the table in a very big way. They've ridden this asset market wave for 30 to 40 years, and which has really been a big moneymaker. It's a cash register, right?
Sure.
And now they're saying they've had enough and they're selling out, leaving them much smaller, only with the wealth management, the private banking arm, and maybe their own asset managers. But they're selling it off, they're shrinking, and they're getting out of that asset management business, which benefited from the rise of asset prices. To me, that is among the most bearish calls I have seen, and bigger than these, an analyst revising their earnings estimates.
Right. It's this is actually, where you start saying Wall Street's actions speak louder than words. It's not an analyst saying, hey, here's a bearish call on equities and we think the S&P top is in, but that's a pretty big shift, if you will, in business practice. And Mark, I mean, just hearing that from you is a really huge insight for all of our traders in our community here at Traders Summit. So, wow.
Of course, it's not that Brown Brothers has to be right.
Right,
but it's just like a yellow flag, something that you've seen develop. Some company that made a huge bet into our industry, and they're cashing out.
Wow. Well, Mark, I'm going to tell you from my point of view, it's so great to speak with you. So great to get your insights. And like I said, for those of you that are watching from home, make sure that you're clicking on Mark's columns every day, because it is how one of my puzzle pieces that I pick up to look at the market. I read what Mark has to say every single morning. So Mark, thank you so much for your insights. And thank you for spending your time today with those of us at Traders Summit.
Thanks a lot for having me. Good luck to everybody.
All right. Best of luck to you. Thanks.